It was a bad case of Monday blues at the Shanghai Stock Exchange. Its composite index fell 3.7% as investors worried about rising tensions between Beijing and Washington. Government officials say they're hoping to reset ties.
Some of the recent wrong actions made by the US on a series of issues are not conducive to enhancing mutual trust between China and the United States. We also hope that the US can change its course and return to the track of working with China.
While their words are conciliatory, the actions from both sides have only stirred up more tensions and led to successive rounds of tit-for-tat tariffs. Investors fear that's a recipe for an economic slowdown. And now the government's taking steps to boost growth. It's lowering the amount of money banks must keep in their vaults so they can lend more. On Monday, the People's Bank of China lowered the reserve requirement ratio for large banks by 100 basis points to 14.5%. A similar reduction for smaller banks will bring their reserve ratio down to 12.5%. The change is expected to free up more than $100 billion that the banks can lend to borrowers. And officials say government steps are already boosting growth.
Logistics is a leading index. Its rise shows the economy has good momentum. The effect of macro policy is beginning to show, and the actions to shore up weak links in infrastructure are supporting the service industry.
But this is the fourth time the central bank has lowered the reserve ratios this year, fueling fears that the trade war with Washington is taking a toll on the economy. And the flood of cheap loans that will follow will only add to China's growing mountain of domestic debt. Mobin Nasir, TRT World.
Let's go to New York next, and joining me from there is Anne Lee. She's the chief executive at the technology investment consortium Coterie and author of the book, Will China's Economy Collapse? And great to have you on the show once again. Are some investors taking the PBOC's move on the reserve requirement ratio as a sign that perhaps the Chinese government sees the economy as being weaker than it's letting on?
Yeah, absolutely. The sell-off is clearly a lot of investors feeling spooked and feeling like this is a signal that the government sees weakness, and therefore they're probably selling on that news in preparation for, harder economic times, not only in China but probably around the world, given that this trade war is definitely escalating.
Right. So how much of this sell-off do you think is related to the trade war?
I think a great majority. It's hard to specifically put a number on it, right? Because there are lots of investors with different reasons. But I would say the majority of the case would be the trade war, because prior to this, everything in China seemed to be hitting on pretty much all cylinders. And there was really not a significant risk to their growth numbers. But given the quick escalation between U.S. and China regarding the tariff situation, I think it's really taken a lot of business people by surprise. It's going to cause a lot of uncertainty in the business environment, which means that decisions are going to be postponed in terms of investments and other trade-related issues. And so this is already filtering, I'm sure, into both economies.
Let's talk about these latest moves by the PBOC. Do you think that they are going to be enough to give the economy enough of a boost to bring it back to the government's target rate of around 6.5%?
It's too early to say, right? I think they are probably going to have to do more down the road because this is a dynamic situation. An economy is, not just a snapshot in time. It continues to evolve, and as more news transpires regarding the trade war or any other geopolitical development that impacts trade and investment, this certainly could have an impact and further slow things down, which means that the Chinese government may have to do even more aggressive measures down the road. Or if there is miraculously some kind of breakthrough and there's relief, then certainly that may not happen. So there's no way to foretell what will happen in the future.
And until recently, the biggest problem facing the government had actually been credit risks and cleaning up the balance sheets of a lot of the lenders in China. Do you think that these latest measures of actually pumping more liquidity into the market is perhaps going to make that problem worse?
It certainly can exacerbate it, but we have to remember that this is China's internal debt. Because it's China's internal debt, so if they incur more internal debt, yes, the debt to GDP ratio can continue to climb and make it worse, but that doesn't necessarily trigger a credit event per se that would cause China to go into some kind of free fall. The government can easily intervene in that situation.
Okay. We are going to have to leave it there, I'm afraid. Anne Lee, author and Chief Executive of Coterie, thank you very much indeed.